the ocean, it starts to travel over land. The frictional effects do lead to pretty quick weakening. But in terms of the coastal impacts from a surge standpoint, there has been some pretty substantial coastal damage from surge. Now, the challenging component of all this is that we don't have too many official gauges where the landfall point occurred. So, and the fact that it is so flat and there's so much marsh and not much elevation, it's going to be tough to find those watermarks. But preliminarily, we're seeing storm surge heights roughly 9 to 10 feet. I would not be surprised areas that were closest to the landfall point where it was even higher than that. The big difference from Katrina is the fact that with Katrina, you had the massive surge that affected a highly populated area, and then you had the levee failure on top of everything else. And that essentially opened the floodgates of inundation across a massive area, a major metropolitan area. So we haven't necessarily seen that. But in terms of the actual wind speed, this was a much stronger storm in terms of wind speed than Katrina was landfall. And you're actually starting to see some of those pictures emerge out of Lake Charles with substantial damage to windows and some of the mid and high-rise buildings there. So this is a storm that I would almost guarantee they're going to retire the name by the end of the season, just given the broad impact. But every storm is different. There's no consistency between a Katrina and a Harvey and any other storm we have. Just the size, structure, and just the overall physical impacts all make these storms very unique to their own.
And Steve, it's Julia LaRoche. And of course, you just mentioned every storm is certainly different. And we also have COVID-19 pandemic as the backdrop here. Walk us through some of the implications that you're seeing as we go through this current crisis or set of crises, really.
Sure. I mean, the biggest concern, obviously, is the humanitarian impact. When you have all these folks that are being forced to evacuate in the COVID environment, you're trying to ensure that emergency managers are keeping folks separate away from each other to not spread. But in terms of the relief and recovery, that is also going to lead to some challenges. We've seen that this year already with other large-scale disasters across the United States, where it's just simply taking a longer time to actually get on the ground and do the assessments, just because different protocols are in place between different companies. There's been much more introduction of, say, drone technology to try to get a quick initial burst of a view of what's going on. So COVID is not going to really affect the financial costs, I would say, but much more on the humanitarian side, and trying to ensure that people can get on the ground and try to help people get back on their feet as quickly as they can. And given the COVID environment, that's going to slow things down, unfortunately.
And Steve, you have coronavirus, of course, in the background, and you also have, on a sort of larger, even longer term scale, climate change and the effect that has had on the hurricane season. How has that led you, both as a meteorologist and someone who works at an insurance company, to change your models for the next several years? I mean, I know that things like offering hurricane insurance has become much, much more expensive as we've seen an increase in storms.
Yeah, I mean, I would say I've been with Aon for 13 years at this point, and there's been a definite sea change in terms of clients and folks from all different types of sectors and their interest around climate change. And we are starting to see some pretty, I would say, noticeable shifts in terms of how these cyclones are behaving. Laura is just the latest example of these storms undergoing rapid intensification prior to actually coming ashore. And typically storms weaken when they get closer to shore because of the frictional effects of land that I mentioned before. But with climate change, these storms are just tapping into some really deep, very warm water, and that's allowing for these storms to become much bigger and much bigger, much more quickly. Now, from the insurance side, we're not just looking at the physical hazard itself, but we're also looking at the fact that human beings just simply love moving to the coastlines. And unfortunately, if you look at statistics over the last couple of decades, there's been a sea change in terms of the number of people that are moving to these highly vulnerable locations. So if you're combining the assumption of more intense storms in the future with more people in harm's way, that's really not a good combination when you're talking about the overall risk.
Yeah, definitely not. Steve Bowen, thank you so much. Really interesting stuff. And meteorologist and head of catastrophe insight. Appreciate it.
Thank you.
Let's get to another big story that we're watching today. It is TikTok. Developments there coming fast and furious. Last night, Kevin Mayer, the CEO, said he was resigning. And in the past couple of hours, CNBC reported that a sale to Microsoft could come within 48 hours. There have also been reports that Walmart teamed up with SoftBank to look at, potentially consider a bid for TikTok. seems like everybody wants it. There's also a report that Oracle is getting closer to buying it. Dan Halley, it's been tough to keep track of all of this. Where do you want to start here?
Yeah, I mean, I don't know where. So outside of what you mentioned, we also should point out that Kevin Mayer may be leaving because he wasn't part of those talks for a potential buyout for TikTok, and that seems to have ruffled some feathers there. But really, he basically had pointed specifically to the political environment as to his reasoning for wanting to take off, and TikTok's press release basically saying, we appreciate his time here, all of 2 seconds, and we're going to try to move on. So they have an interim head of the company now, but what we're looking at now is it seems like Microsoft is the right suitor for this out of the available suitors. They do have experience running social media with LinkedIn. They've done well with LinkedIn. It generates revenue for them. Of course, there's also a subscription service for that and different revenue streams that they've been able to pull from. So I don't know if they'll be able to get that out of TikTok. It's mostly going to be advertising there. But they also have their cloud infrastructure that they can work with. But it's going to be difficult for any company to separate the various portions of TikTok that the U.S. government wants separated from ByteDance's properties. We're talking about the United States, Canada, New Zealand, Australia. Those would be broken off potentially into a separate entity, and then the standard TikTok for the rest of the world would just remain in place. But breaking those in half is going to be pretty hard, and Microsoft seems to have the wherewithal to do that. It would take time. They're going to need some kind of extension from the Trump administration to allow the app to continue to function while they break it apart. You have to imagine ByteDance is going to get a pretty penny for this. Oracle doesn't seem to be the right fit for something like this at all. I feel like it's like asking your, 80-year-old uncle to try to run an app for teenagers. It doesn't really seem to line up very well. No offense to 80-year-old uncles out there. But, the real reasoning for Oracle to be a part of this is because Larry Ellison has ties to the Trump administration. Sequoia Capital has ties to the Trump administration, has ties to TikTok, and has ties to ByteDance. And that's really kind of where they want to break it apart there. But it really does seem like Microsoft is the best bet. And Walmart, what is even happening there? That doesn't make sense at all.
Dan, I want to ask you, because you just laid out that it seems Microsoft is a front runner. Walk us through why someone like Walmart would even consider or look at something like TikTok. What's your best guess there?
It's a fabulous question. I don't know. I mean, they're trying to get more into the digital space, obviously, trying to compete with Amazon in the digital space, which makes sense. Also with their, the physical deliveries, trying to speed up the timing for that as well to compete with Prime. And they are working on video services similar to what Prime Video has, but there's nothing that has to do with social media with Amazon, its primary competitor. So why get into something like this? And, the thought may be, okay, we can get data on teens to understand what they're looking at. We can help build out what we may need to offer in stores to attract younger customers. But, Walmart is a store. I don't understand how TikTok would really help with that. We're getting, TikTok influencers and, they're salespeople basically, but, it doesn't seem to match up there as well as it would with something like a Microsoft.
Doesn't seem obvious, that's for sure. All right, thanks, Dan. As we take a break, I want to bring you a couple other stocks on the move. Those Microsoft shares are up, by the way, about 3%. But shares of Coty are down 6%. The company said sales fell 56% last quarter. That is a bigger drop than estimated. The company did say it saw significant improvements in July and August and expects to return to profitability in the current quarter, but only on an adjusted operating income from continuing operations basis. Adjusted gross margin at Coty down by 20 percentage points last quarter. On the flip side, Abercrombie and Fitch doing pretty well. Those shares are up by 16%. They reported an unexpected profit per share ex items. Revenue was down 17%, but that was above estimates. And digital revenue was up by 56%. So we'll continue to watch that. Coming up next, the details on that new quick, cheap test from Abbott Labs. You just heard our sort of incredulous conversation about Walmart potentially making a bid for TikTok or participating in a bid. Now CNBC is reporting that actually Walmart has come out with a statement. Actually, I'm seeing a Bloomberg's report. Walmart says in a statement that a quote potential relationship with TikTok US in partnership with Microsoft, not SoftBank, Microsoft, could provide Walmart a way to reach customers and grow its third-party marketplace and advertising business. And we were just talking about that it doesn't seem intuitive that we would see this kind of partnership with TikTok. Walmart does have a pretty substantial digital operation, and those Walmart shares are spiking right now. So we're going to continue to track this and cover it for you. But right now, we want to talk about the new Abbott Labs test for coronavirus. The Food and Drug Administration has granted emergency use status to a $5 COVID-19 rapid antigen test developed by Abbott Labs. Anjali Kamlani is joining us now. So this seems like a pretty big deal, Anjali, if there are still people who are seeing delays in getting tests and accessibility of tests.
That's correct, Julie. And we've seen those delays really in those lab performed tests. And so this is why this is a game changer, as some analysts have pointed out. What this antigen test does is it detects that the virus is in your system. Unlike the PCR that confirms fully that you do have this, the antigen test detects part of the virus, but then confirms that you currently have the virus in your system. And the reason why this is so important, this test specifically, is it's a turnaround time in 15 minutes. It's $5, as you mentioned, very affordable test. And that $5 is really for whoever the buyer is. And they're really targeting, a lot of the places that a focus has been for testing, which is schools, workplaces, anywhere where there's a sort of a mass gathering of people or a lot of people trying to enter one place. And in addition to that, they do have an app that is going to be attached to this test where you can get the results. And if you are clear of the virus, you can then get a health pass that has an expiration date. So it's, sort of goes along those lines of what we've been talking about and what health experts have been asking for. The technology is similar to an at-home pregnancy test, though this cannot be done at home. It still requires a reagent to then, process the test, but it's the closest thing, and it's really small and portable. So a lot of factors play into why so many people are excited about this new test.
Anjali, thank you so much. Appreciate it. Well, we want to get to sports now because there were some important developments. The Milwaukee Bucks' decision to protest and not play their playoff game following the police shooting of Jacob Blake cascaded into protests across professional sports leagues, the NBA, the WNBA, Major League Soccer, and Major League Baseball. Dan Roberts has been monitoring all of this for us. This is the most significant protest that we have seen yet in professional sports.
Yeah, I would agree with that, Julie, although in many ways, I hesitate to say unprecedented because it feels a lot like 1968. A lot of people resharing that famous photo of the athletes at the Olympics putting up the fist. But I would say that yesterday felt in many ways like that day in March when the NBA shut down, and then there was a ripple effect of many other leagues shutting down. Of course, that was for COVID-19. This is for social justice. So very interesting to think that a lot of these sports managed to come back amid the pandemic, and now we're pausing because of this. But as you mentioned, the Bucks really started off. Of course, the shooting happened in their home state. That game was canceled. Then all three of the NBA playoff games last night were canceled. The WNBA canceled games. 2 Major League Baseball games were canceled. And MLB, typically not a league known for really taking a stand on social activism. And so now in the 11 a.m. hour, we had 2 meetings happening simultaneously. We're waiting to hear what comes out of those. One is the NBA Board of Governors meeting at 11 a.m. And at 11 a.m. also the NBA players in the bubble right now had a meeting to discuss how to continue the season. If I had to predict, I don't think the NBA season is going to end here. A lot of people saying this is it, it's over. I don't think so. I think the players will release some hopes or demands, you could say, for what the team owners should do. That's what LeBron James came out and said. He wants the owners to do more on social justice. And if the owners will do it, and if the league will do it, the players can continue. Also, arguably, they can say more from their platform while playing than by completely canceling the season. But we'll see what happens. And I would also add that even the PGA Tour released a statement saying we fully support these protests. Now, it's just words, but boy, when you see pro golf doing it, there is something stunning happening right now across the entire sports landscape, for sure.
And it'll be interesting to see what kind of concrete action that they want to take here. In the meantime, reportedly, Jared Kushner said he's going to reach out to LeBron James on this issue and sort of made this comment that these players have the luxury of taking a night off from work. I believe it was Politico that quoted him as saying that, but I don't know what that will accomplish.
Right. I don't know how much we're going to get out of that phone call, but it should be interesting. It's just a reminder too. It's LeBron's league. I don't think that's controversial to say. There were reports initially of when players talked last night that a majority of players wanted to continue the season, but the Lakers and Clippers both voted to walk out, and that it was all led by LeBron. So if LeBron wants to stop the season's going to stop. We'll see what happens.
We will. Thank you so much, Dan. Appreciate it. We've got gold prices down about 1.5% today. We will discuss that next. We are seeing gold prices, as I mentioned, pull back today by more than 1%. They're still above $1,900 an ounce. Let's bring in Porrick Garvey to talk about this. ING Managing Director joining us from New York. It seems like this would be bound up with what we heard from Jay Powell and the change that the Federal Reserve is making in terms of switching to average inflation targeting. Can you please sort of break down what the Fed's change means for gold specifically?
Sure. So thanks for having me. The gold price is a very, very complex beast. Typically, you will have a bid to gold if you have a classic flight to safety. And we saw a bit of that over the past number of months, I would say. The initial flight was into the dollar. Since then, it's been into gold. That's been a very good rationale for the gold to go higher. Now, the inflation component is a bit more complex because gold is also a place to go if you're trying to seek refuge from inflation. The problem we have right now is we don't have any inflation. And one of the things that Powell was trying to do today was to telegraph to the marketplace that we have a big problem right now. We have not been able to generate inflation. And going forward, what we're going to do is we're going to allow inflation to rip slightly because it's below trend right now. So normally that would put upward pressure on the gold price. That hasn't happened today. And I see that as just gold not reacting to Powell very much today, to be perfectly frank.
It's Julia LaRocha. And you were just kind of referencing some of the reasons to own gold. And of course, it can be pretty dynamic. It can be, I guess, a flight to safety. I also wonder about folks not wanting to be in treasuries, kind of using it as an alternative to owning treasuries, given where yields are. talk to us about some of the things that you're going to be looking for as reasons and drivers to own gold going forward.
Yeah, I mean, it's, if we look at gold, it's a very simple product. It's all about price. You don't get paid a coupon, you don't get paid a dividend. So you buy gold for a pure price appreciation context. So this is why gold has been compared to treasuries right now, because treasuries, you get a yield, but it's not very much. But the difference between the treasury price and the gold price is that when you buy, let's say, a 30-year treasury bond, after 30 years, you're going to get par. Whereas if you buy gold after 30 years, you hope for price appreciation. So it's got that diversification context vis-a-vis treasuries. And it's also useful as a hedge versus equities as well. I mean, equities have had pretty much a fantastic run. And I mean, I see gold right now as a diversification play, but also something that offers the ultimate safety in an environment where I would say over the next decade, it's very difficult to understand exactly where we're going to be.
Yeah, in the next 6 months, it's difficult to understand, let alone in the next decade. Park, finally, do you then have a price target on gold in the short or in the long term for that matter? As you said, we have seen a pretty incredible run up over the past 3 to 6 months. Is that going to keep going despite today's pause?
Yeah, I would say so. I would imagine that over the next 12 months, we're looking at a 10% uplift in the gold price. It's notoriously difficult to model, but in the bigger scheme of things, given that there isn't an awful lot to go for in terms of the bond dynamic, something like 10% would make an awful lot of sense. There's nothing out there to suggest that gold price is necessarily going to collapse from here or fall from here.
Gotcha. All right. Park Garvey is ING Managing Director. Thank you so much for joining us.
Sure.
As we know, Salesforce shares got a big spike yesterday in the wake of their earnings. Julia had the chance to speak with Salesforce CEO Mark Benioff, and this is what he said.
Well, I think one way to get increased performance today for a CEO is to focus more on your relevancy during times of the pandemic. This is a critical time to assess, do you have the right products? Do you have the right people? Or do you have the right messaging? Are you able to communicate to the world exactly your level of relevancy? And that's one reason we built Work.com. We now have a product that does contact tracing, shift scheduling, workforce command centers. It's in place for thousands of companies, but it's also in place for 35 states. It's how they're doing their contact tracing. When we were together at the World Economic Forum in January, that product didn't exist, Work.com. Now it's a mainstream product in our businesses and how we go to market. Every company needs this. Everyone has to be able to do contact tracing to be able to keep the pandemic at a reduced level in their organization. That's an example of relevancy. Another example is something that happened this quarter. You saw we introduced an incredible new product called Salesforce Anywhere, because all of our customers need to sell, they need to service, they need to market, they need to conduct their e-commerce from anywhere. I'm talking to you from my home, you're in your home, everyone's in their home. That means that we have to have different kind of tools to be able to operate. That's why we introduced a new type of product that let people do CRM from anywhere.
And you can see more of Julia's interview with Salesforce CEO Mark Benioff as part of our Yahoo Finance Presents series. You can check that out on yahoofinance.com. When we come back, we will be talking rare earth minerals. Stay tuned. It's time now for news on the move. The Department of Justice has opened an investigation into the police shooting of Jacob Blake in Kenosha, Wisconsin, as the state attorney general said Blake was near a knife when the shooting took place. Meanwhile, a 17-year-old from Illinois was arrested in connection with another shooting that killed two men during protests in Kenosha on Tuesday night. A new UNICEF report measures the coronavirus toll on learning for the world's children. At least a third of the globe's school children, 463 million kids, could not access remote learning while their schools were closed because of COVID-19. Even when children could access technology, the report concludes, their learning might be interrupted or prevented by competing factors at home, like pressure to do chores. Jeff Bezos yesterday became the first person with a $200 billion net worth. The Amazon founder and CEO has seen his wealth surge by about $87 billion this year, mirroring an 85% climb in Amazon shares. Elon Musk also reached a milestone, becoming a centibillionaire, that's $100 billion, amid a more than quintupling of Tesla's stock. It is time for tech support now, and we're going to send it over to Dan Howley, who was talking to us about battery life. We're not talking about the iPhone for a change when it comes to battery life. You're talking about a different Apple product, Dan.
That's right. We are talking about, of course, the AirPods. Now, these are 4 years old. They're practically iconic now. But because they're 4 years old and because people use them so often, we're starting to see a degradation in their battery life. So if you're seeing the battery on your AirPods start to fall apart, this is what you need to do. Now, first off, bear with me. It might not be the batteries. What I want you to do is go in and check the little lightning port underneath your AirPods. I'll give you a little look right there and dig around in there. If you see some pocket lint, use a toothpick, something that's non-metallic, and see if you can get it out. Now, you want to be very careful when you do this, because if you break the pins inside, Apple's not going to replace it for you, especially if they find a piece of broken toothpick inside there. But it could end up clearing it out, and it could allow the case to charge again and then recharge your actual AirPods. You can also, if you have a wireless case and it's not charging on the pad, you can end up just charging it using a regular plug, and that might work as well. Now, the AirPods use lithium-ion batteries, and that's something that we use in every smartphone around the world. Basically, any kind of portable electronic that you have. They're great because they can hold a charge for a long time, they charge quickly, and they don't run down terribly fast. But over time, like any other battery, you go through enough charge cycles and they end up degrading. And that's where you start to see it, where you may be able to put your AirPods in for 30 minutes and then they just don't last any longer. They're supposed to last between 5 and 4.5 hours, depending on the model. So when you get down to 30 minutes, you're going to start to have a problem. So what I want you to do then is take your AirPods to the Apple Store. If you have something like Apple Care Plus, that means they will replace your AirPods battery for free, regardless of which version you have. Even if the charging case isn't working, if you have Apple Care Plus, they will change it for free. If you don't, here's the rub. It's $49 for each battery. That means in each AirPod, it would be $49. We're talking then about $98 total to change the batteries in both your AirPods. Whoa, that's a lot of money, right? Yes, but it's also cheaper than buying a new pair of AirPods. The base AirPods right now are $149. That's for the regular AirPods. You go for the AirPods with the wireless charging case, these little guys right here, and that's going to be $199. And then you go up to the AirPods Pro, and those are $249. So $98 isn't looking too bad when you're looking at prices like that. So now you might be thinking, okay, well, there's an Apple event coming up. Am I going to see new AirPods? What should I do? My suggestion is, if you don't want to blow money on another pair of AirPods, just go for the battery. Yes, it stinks, but at least you're going to have the charge that you used to have. If you just want to get a new pair of AirPods, though, hold off until the September event to see if Apple unveils a new pair. There's been talk for a while about something called Studio AirPods or AirPods Studio. That would be maybe an over-the-ear version of an AirPod, AirPods Lite, which may be a cheaper version. If you want that, definitely hold off until the September event, which, may be in the middle of the month, the end of the month, depending on when they do it now. But they could launch a new pair of AirPods, and then you might want to go to the store and buy those just to have something brand spanking new. But if you really don't want to spend the cash and you like what you have, just do the $98 for now.
As always, I'm anticipating the chip implantation in my brain that will do it all. Dan Halley, thank you so much. Appreciate it. When we come back, we will talk to the company behind the only operational rare earths mine in the US. We'll be right back. I've been talking a lot this year about the increasing popularity of doing deals through SPAC, special purpose acquisition companies. And one of our guests from last year is doing that. James Litinsky is MP Materials CEO. MP Materials is going to be listed on the NYSE through a merger with Fortress Value Acquisition Corp. MP Materials, by the way, the operator of the only functioning rare earths mine in the US, Mountain Pass in California. James, it's good to see you again. So why did you decide to do a go public through a SPAC versus, say, doing an IPO?
Sure. Thanks, Julie. It's great to be back on your show. So we considered a lot of options as fiduciaries. We looked at an IPO. We looked at some strategic options. The SPAC structures have changed a lot. Historically, they had a sort of mixed incentives with the structure, but we were able to partner up with Fortress and put together a deal that we thought was great for all stakeholders and got us to market efficiently. So it was really a great structure for us.
James, it's Julia LaRoche. Let's talk about business for a second. It just struck me, you all are the only rare earth minerals, I guess, miner in the United States. Is that correct? Is that what I heard?
Sure.
Yeah, let's talk
yes.
about that.
Well,
Yeah, I would love to unpack that further because obviously rare earths are used in so many different things. They're super important. What's kind of going on in your space these days? I think our viewers would be especially interested from your point of view.
sure. Well, the first thing is rare earths are actually not particularly rare. What's rare is the concentration in an ore body, as well as the scaled chemical production that's required. It's really closer to a specialty material. Um, Over the last couple decades, the Chinese have taken over the industry due to sort of state subsidy as well as lax environmental controls. Our site, though, is sort of the storied, best world-class asset in rare earths. We have the benefit of having a very high concentration of rare earth, as well as $1.7 billion of invested capital in the chemical separations facility that's required, that is co-located right there. And so our site actually sits in California. So we have the benefit of not only being able to compete globally, cost effectively, but sustainably as well.
James, you talk about China and the issues there. Obviously, there's a lot of rare earth minerals in Africa as well. The environmental impact of both of those can be severe. How do you guys mitigate that when it comes to your mining operation? And what exact minerals are you mining? What are they going into?
Sure. Well, I think first and foremost, as a company, we need to just be maniacal about costs and be a low cost producer. We are one of the lowest cost producers in the world. We have a significant head start by the fact that we have the ore body that we have. We don't have the environmental issues that they have in China or Africa or elsewhere in the world. But I think also as this next decade unfolds, what we really would like to see is sort of a broader push from the major corporate citizens. If you think about the Teslas and Apples of the world, their consumers are really focused on sustainability. We can certainly talk about the boom that's now happening in electric vehicles and the decarbonization that will happen in the decade to come. And we think it's really important. For example, on our site, we use 1/20th of the water that a typical alternative operation would use. We have a number of attributes that probably be too technical to get into, but we are a green, environmentally friendly site. And we think that the consumers who are purchasing these sustainable materials, specifically for electric vehicles, wind turbines, drones, robots, that they do care. And so I think you're going to see a broader push from the big companies to push for their supply chain. I would say, for example, on the last earnings call, Elon Musk said that they're very focused on getting environmentally conscious nickel. I think you're going to see those kinds of statements really play out across the mining materials space, which means our company is really well positioned to provide product.
James, very quickly, speaking of well positioned, first of all, is Tesla a client? And second of all, the Trump administration wants to source more rare earth minerals in the United States. Are you getting assistance from the administration?
Well, so we represent about 15% of the global rare earth supply today. Our plan is to continue to move downstream, and ultimately, the rare earth materials get made into magnets. So the Teslas of the world, for example, are purchasers of magnets. They currently buy all of their magnets in China. But as you mentioned, the Trump administration or any administration, I think this is a nonpartisan issue for supply chain reliability and sustainability. We really want to get a lot of this production back here in the United States of America. And so that is really our company, which, MP Materials, that's our focus strategically, is to continue to move downstream to transform our business from just providing materials to onshoring the entire supply chain all the way down to the magnets and beyond. So we hope to, we hope you'll hear good things from us on that front in the years to come.
We will count on you to come back on and share them with us.
Sure.
James Litinsky is MP Materials CEO. Thank you so much,
Thank
James.
you.
Appreciate it.
Thank you.
Want to turn to Starbucks now. Julia, you are covering a letter that Starbucks CEO Kevin Johnson came out with that has to do with voting and election day. What does it say?
Yeah, Starbucks CEO sent a letter to the 200,000 US employees, basically telling them, look, the company's making a major step forward, so you do not have to choose between working a shift and voting. They want to help get folks registered to vote, help them understand how to do the whole mail-in process, and even encouraging the employees to, staff some of the polling locations. Kevin Johnson writes, the upcoming election is a reminder that we as citizens play an active role in society by simply getting involved in voting. Who you vote for is a very personal decision that you make as a citizen. It is one way to be heard. It is how democracy works. Yet we know that barriers exist, notably in Black and Brown communities throughout the nation, that lend to systemic racism and require greater voter access and protection. So this is about Starbucks really honing in on its civil rights platform, if you will. They've been doing an audit in the past couple of years. I know they worked with Eric Holder on that audit, and this is another key component is voting, and also extending that to the customers. They're going to be using that popular Starbucks mobile app to raise awareness, partnering with nonpartisan organizations about how to register to vote, where you can vote within your community, and how to do the whole mail-in ballot process. Of course, this is an election a lot of folks will be talking about, and I think it's interesting to see more and more companies come out with initiatives to get folks to the polls and get their ballots in.
It is corporate America really pushing for that. Thank you, Julia. Thank you, Dan Halley, as well. When we come back, we are going to be getting a market check as the Dow erases its losses for the year. It's up 0.9%. We'll be right back. Stocks rallying across the board today if you look at the three major averages, and part of that has to do with the rally in banks specifically. Jared Blickery is here with more details. Jared?
That's right. All of Powell's inflation talk really expanding the yield curve, and the 10-year is at the highest level that we've seen in several months, about 71 basis points. But bank stocks, as a result, are leading right now. JP Morgan up nearly 3%, Bank of America up 2%. We'll take a quick check of the NASDAQ 100 heat map. Apple and Amazon are slightly underwater, while Facebook giving back some of yesterday's gains. It's down 2%. And Microsoft, on that TikTok news, is up 4% today. Well, let's take a look at what's happened over the month of August. And we can see in the Dow up 8%. In the NASDAQ, we are up 9%. And the S&P 500 up 7%. Now let's take a look at that 10-year yield, because we have a series of higher highs and higher lows. And that means the trend is up in yields. Well, it's time now for our Yahoo Finance premium investment idea of the day. And this is Hormel Foods. And Argus Research is raising their price target to $58 and maintaining their buy. 58 would be somewhere up here. Also saying that Hormel Foods produces and markets meat and food products to retail, food service, deli, and commercial customers in the US and internationally. Also, the shares have outperformed the market over the past 1 and 5 year period. The company has plenty of cash on the balance sheet and an experienced management team, two factors that we think are important during the pandemic. Julie?
Thanks, Jared. Appreciate it. Well, when we come back in the next hour, we will be talking more about the implications of Hurricane Laura, particularly for the oil and gas industry, as well as more on the reaction to the Federal Reserve. We'll be right back. It is noon here in New York. We're 2.5 hours into the trading day, and we have seen a rally in stocks. It's given up a little bit of steam, but still higher on the day, and it's enough to send the Dow into positive for the year. It's up 0.9% at the moment. The buying in stocks comes following comments from Federal Reserve Chair Jay Powell at the virtual Jackson Hole conference, a big, if not surprising, policy change on inflation. Laura makes landfall. The hurricane slams the southern U.S. coast as a Category 4 storm. What you need to know is winds topped 150 miles per hour in the region. And TikTok shuffle. CEO Kevin Mayer is out and major players may be in. The latest as Walmart may join Microsoft in a bid for the social network. Welcome to On the Move. I'm Julie Hyman. Adam Shapiro is off this week. Joining us this hour on the panel will be Yahoo Finance's Brian Chung and Melody Hom. We want to start here with the hurricane. The latest there, as Reuters was reporting, it has weakened to a Category 1 storm as it continues to hover over Louisiana. To talk more about the effect on the oil and gas industry in particular, we're joined by Basil Karempoulos. He is Sierra Constellation Partners Managing Director. He's joining us from Houston. So Basil, you're there in Houston where I know there was a bit of a storm surge and some effect from the storm as well. What effect are we seeing on production? Not just right now, obviously, but how long does it take to start to reopen production in the Gulf, especially after a storm of this size?
Well, Julie, thank you for having me. You know, first off, is the human toll is what's really paramount here, and my heart goes out to the folks in that region. You know, I've been in this area now for 30 years and spent a lot of time in Louisiana. In fact, we're supposed to be in Louisiana this week for work, and I think the human toll is really what's going to drive the restart. And what I mean by that is there are people that are going to be displaced, and if they are having to find a new place to live, or they're dealing with flood damage, or worse, you know, destruction of their homes, that may prevent them from going back to work. And so facilities might be able to restart from an operating standpoint, but from a HR standpoint, from a personnel standpoint, they may be hindered. And I think that's something that only time will tell in terms of what that impact's going to be.
And of course, the backdrop for this as well is that this is sort of a challenging time for the oil and gas industry as it is, at least in terms of prices and what we have seen happen over the past 6 months during COVID. Yes, demand is starting to come back, but we're still seeing pretty suppressed prices here. So what does the price action look like in the coming weeks?
Yeah, I mean, I've been saying that 2020 is the year of the frackening, and I think that is going to continue. We are in this middling range of, you know, $40 to $50 a barrel, which is about 30% below where we were pre-COVID. And, you know, that's something that we're expecting is going to continue well into the next year. The demand simply isn't there at the level they need. And every time the demand picks up, production sort of rises up to meet it, which is one of the things that's going to keep prices suppressed.
Hey, Basil, it's Brian Chung here. I wanted to ask about the precedent for the hurricane, moving back to that topic down there in Texas, Hurricane Harvey obviously being the last one to really hard hit the region. What's the comparison, the differences between these two storms here, and what will the estimated impact be because of that pandemic being unique to this situation versus Harvey?
No, great question. I mean, I think we're really in uncharted territory here. You know, I evacuated before Harvey, so I wasn't here to sort of see it happen when it happened. But the difference is really that this was much more of a storm surge and wind event, whereas Harvey was much more of a rainfall and flooding event. So I think that has, you know, there's some positives and negatives, so to speak, with regard to the different type of event that you have. But I think that regardless of what kind of event you have, when you have facilities, large refineries and petrochemical facilities that shut down, one of the biggest risks you have, regardless of why they're shutting down, be it rain, wind, storm surge, the issue you have is startup is a very dangerous time at a refinery and petrochemical facility. In fact, if you take a look at when we've had significant industrial accidents at those types of facilities, it typically has been during a startup phase because you've got things moving around, you've got the risks of trapped vapors, et cetera. So I think regardless of that, of what type of hurricane we had, but, you know, obviously the wide-ranging impacts of the floods of Harvey are something we're not going to see here because you had a much more narrow storm band, so to speak. But by the same token, this was a Category 4 verging on a Category 5, and so the type of catastrophic damage you're going to have from that wind field is going to be, you know, significant, and in terms of the power outages, which obviously creates a lot of issues for folks, especially in the hot summer season that we're in right now.
And Basil, thinking about those potential accidents and also potential supply disruptions that happen during the restart, what are ways to mitigate that? Are there actual kind of best practices that you've been advising folks that have been developed, as unfortunately the region has suffered through hurricanes over the years?
Yeah, I think, you know, one of the things that's important to remember is that the part of the country that took the brunt of this hurricane provides only about 12, 13% of their refined products. So there's significant slack in the system that can be filled by refineries down in Corpus Christi and elsewhere along the Gulf Coast. So as long as you have a pipeline system that's able to carry that refined product up the coast, I think that will allow companies to be able to take the time and do a safe startup and do it with the level of staffing that they need. But it's really tough to, other than really learning from mistakes of the past, it's really tough to, coach on, a safe startup. A lot of it has to do with the facility and whether there was any flooding damage and things like that. So really, prudence is going to be the coin of the realm.
Basil, thanks for joining us with your perspective. Basil Karampoulos is Sierra Constellation Partners Managing Director. Thank you again.
Thank you.
We have to turn to the Fed now because the Federal Reserve this morning made some changes to its policy with regard to inflation and inflation targeting. Chairman Jay Powell making that announcement in the virtual Jackson Hole conference.
We continue to believe that specifying a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. The significant shifts in estimates of the natural rate of unemployment over the past decade reinforce this point. In addition, we have not changed our view that a longer-run inflation rate of 2% is most consistent with our mandate to promote both maximum employment and price stability.
So not necessarily a surprise here, but it's being greeted enthusiastically by the market, I think it's fair to say. Matt Miskin is joining us now. John Hancock, Investment Management Co-Chief Investment Strategist, is joining us now from Boston. And indeed, Matt, we're seeing a rally here in stocks, seemingly on the back of these Powell comments. I don't think anybody thought rates were going up anytime soon regardless, but is this sort of a confirmation of that, and that's why equity investors are excited about it?
Well, it's interesting seeing the actual makeup of the gains today. Financials are actually one of the best performing sectors, and interest rates, the 10-year is actually backed up a couple basis points. So in our view, the market was interpreting this, was going into this thinking that Powell's going to be even more dovish. And perhaps he wasn't as dovish as he could have been relative to expectations. And, that's fine. The Fed has been doing a lot and has already done a lot. But it's helping a little bit of a small rotation today in the market, and that's helping buoy, the Dow versus the NASDAQ. And the Dow is having a nice day. We'll see if this has legs. In our view, it probably doesn't, that the 10-year does back down after today. But it's a welcome sign that, the overall market can participate in this broader rally.
Hey, Matt, it's Brian Chung here. Tell me a little bit more about your read on the bond market. You were mentioning the 10-year, for example. It's been going up. I think it's 5 basis points so far. I mean, one interpretation of that is the Fed says it won't be raising rates anytime soon under this new framework. So maybe that's bullish for stocks, keep buying on the way up. But at the same time, does this back up the Federal Reserve into having to pin down longer-term interest rates through whether or not it's a more expanded QE on the longer end of the curve, or even implementing, ironically, some sort of yield curve control because rates on the long end going up?
Yeah, I think that's a great point because, as the Fed has said, in saying this, they're basically saying we're going to let inflation run hot. We're going to keep interest rates exceptionally low. And yet the bond market's interpreting that with a steepening of the curve, with the 10-year actually rising a bit. So that it wasn't, to the script of what Powell was likely looking for. Our view is that basically the Fed is using their balance sheet in massive amounts here, and that the balance sheet is being used to pin down the 10-year Treasury. They haven't instituted yield curve control yet, which was, to your point, kind of making sure that the 10-year doesn't back up, but they've got that in their pocket. Japan's done it. Europe's interest rates are negative. So the Fed has the ability to do that. But I think what they're doing is they're waiting till they need it. And with financial assets rallying, the S&P, the Dow at all-time high yield spreads exceptionally low, right now they don't need it. The markets have done everything they wanted them to do, for the Fed at least to this point. But if we get another bout of volatility, if some of the weakness we're seeing in the economic data starts to flare up the market, we would expect yield curve control or another additional stimulus measure in the next couple months to be introduced.
If you look at the economic data we've got very recently, though, doesn't feel like that we're seeing significant rockiness, right? Maybe a little bit of choppiness, but even today, Second quarter GDP, yes, of course, was down a lot on an annualized basis. It wasn't as bad as the first read. Pending home sales up a lot. Yes, jobless claims. I mean, it's not as though everything is hunky-dory, but is there any big cause for alarm in the numbers that you've been seeing?
Yeah, so I mean, to your point, I mean, the Fed put interest rates so low and has done so much that one of the biggest bright spots of this economy is the housing market. It doesn't seem to fail that low interest rates helps housing. But what it isn't doing is providing a lot of confidence. And just the other day, we got the consumer confidence data out of the Conference Board. That continued to drop lower. And the spread between the consumer confidence data and the S&P 500 is showing this massive gap. And it's very atypical. Usually confidence in the S&P and stocks go together. But what you're seeing is this big divergence between people feeling scared. They're feeling scared about their job. They're feeling worried about how the economy is going to do. They're worried about, second wave. And so that lack of confidence is potentially going to weigh on spending in the back half. And, we've had a great run here. But that's really what we're watching as the negative element. Yes, we totally agree. There are some good bright spots in this economy, but if those negative elements weigh on it, I think Powell and the Fed are going to have to bring more stimulus to the table in the next quarter.
Well, and that's an excellent point that you make there, which is that consumer confidence going down is going to make it hard to stimulate consumption, which thereby is also going to make it hard to inflate or raise inflation expectations. So with the change that the Federal Reserve made just a few hours ago, is this a losing mission here? Is the Federal Reserve really fighting an uphill battle and trying to raise inflation expectations, which is already something they've had issue doing over the last 8-year period?
Yeah. So, I mean, you look at a chart at core PCE, which is their preferred measure of inflation, and you put it against their 2% target. And I mean, they have not hit that 2% target for very often in the last decade. 2018 had a brief stint. But, I think this is it is a bit of a losing battle. And I mean, it's not just the Fed. Look at the Bank of Japan. I mean, you think that the Fed's bad at trying to say, hey, we're going to hit this 2% target. The Bank of Japan's not even close, and they still have a 2% target. So I think it's a realization of central bankers saying, we can't come out with this tune forever saying we're going to hit 2% with this technology advancement, with the demographics that are there, with these broader secular trends. We need to change this. And I think it's a good step. But at the end of the day, how are they going to do it? And I think that is what they missed today. That's what Powell didn't say today. This is how we're going to bring up inflation regardless. That was completely lacking. So in our view, inflation does stay relatively modest, and much of the trends we're seeing in the markets likely remain intact.
Maybe you didn't say it because they can't at the end of the day. Matt Miskin, John Hancock Investment Management, Co-Chief Investment Strategist. Great to see you as always, Matt. Appreciate it.
Good to see you guys. Thanks.
Let's get to politics now. We had night 3 of the Republican National Convention, and Vice President Pence spoke and really emphasized law and order in his speech, continuing with an ongoing theme that we have heard throughout the convention. Our Jessica Smith is joining us from Washington with her assessment. Jess.
Yeah, Julie, as Vice President Mike Pence accepted the nomination once again, he made it clear that the Trump administration is standing with law enforcement. And this comes amid the growing protests that we're seeing in response to another Black man being shot by police. Pence did reference violence in Kenosha, Wisconsin, but he did that without mentioning Jacob Blake by name or what happened to him. He says that the Trump administration stands with those on the thin blue line, and he used Biden's acknowledgement of systemic racism in the United States as an attack against the former VP. He talked about chaos and violence in American cities and issued this warning to voters.
Joe Biden would double down on the very policies that are leading to violence in America's cities. The hard truth is, you won't be safe in Joe Biden's America.
We heard similar messages from other speakers, including Senator Marsha Blackburn and South Dakota Governor Kristi Noem. President Trump did make a semi-surprise appearance last night at Fort McHenry after this speech. There was a crowd of about more than 100 people there, and largely without masks. And Trump and Pence did interact with those people after the speech. So another clear difference in how Republicans and Democrats are handling their conventions. President Trump will formally accept his renomination tonight at the White House. We'll also hear from speakers including Ivanka Trump and several other Republican lawmakers. Julie.
Jess, thank you. Appreciate it. There's also on our next story some interplay with politics, of course, and that is the sale of TikTok. A lot of reports about who could be in the running to acquire the company's U.S. operations, and some of who wins might have to do with their relationships in Washington, as well as the idea that was also reported late yesterday that Kevin Mayer, the CEO, was stepping down. So a lot of different things that we are tracking having to do with this. Melody, I know that you are watching this story. One of the most surprising developments to come out today, Walmart says it is joining in Microsoft's efforts to buy TikTok.
I do want to point out, Julie, that I'm out to Walmart and Microsoft for a comment. They have not officially confirmed this to us, but we do know that CNBC is reporting this news. Walmart shares up right now 5.5%, Microsoft up over 3%. What I want to point out is that Walmart has actually done a very good job. I know, when the news first broke, we were all kind of scratching our heads a bit saying, does this partnership make sense? But I have to point out that Walmart has invested heavily in TikTok campaign way before a lot of the competitors. So even in September of last year, it launched a campaign trying to reel in teens to use the hashtag Walmart 2-Hour Express, basically showing fun dances, wearing Walmart clothes, and they could win some really high-end products from Walmart to get delivered within that 2-hour window. I also want to point out that Walmart has that long-standing relationship with China, whether it's that partnership with JD.com, they're fully entrenched. And that's the same sort of argument that has been made with Microsoft, right? They fully understand and have kind of traversed the relationship with the Chinese government in a way that other social media giants here in the United States have been very unsuccessful at doing so, and if anything, have caused more friction in the process. So yes, this Kevin Mayer stepping down news is quite surprising, but I do want to kind of indicate, I actually was speaking to some sources last night when the news broke. People within the company themselves are completely confused, right? They're learning about all of these developments as this is happening. So they're not actually, they almost are like the boy who cried wolf at this point. So there was a product operations manager at TikTok who did speak to me anonymously. And he essentially said, we're not even getting these updates in real time. And we're reading about this through reporting. And unfortunately, I don't really have confidence that these deals will actually happen until we see it firmly signed and delivered. So I just want to point out, yes, that these are quickly evolving and moving negotiations, but these strange bedfellows like the Walmarts and like the Microsofts could actually be perhaps the safer play from the side of ByteDance, where they're trying to find sort of partners that understand their ecosystem and the way that the CCP does work.
Hey, Melody, help us, understand the retail side of this as well. It seems like Walmart is a surprising name to be hopping into the ring. But as you pointed out, the CFO of Walmart had said previously it's got a mountain of cash it could deploy here. And then if Walmart is entering the bidding ring here, it seems like everyone and their mother is also in it. Does this mean we should expect to see the likes of Amazon or other types of large retailers maybe get into the game as well?
Yeah, Brian, I want to point out that actually TikTok approached Netflix. That was one of its desired acquirers. Netflix turned down the deal for whatever reasons. But if you think about the other players in the mix, like you say, there's no one that's off the table at this point. I'm sure Amazon has been in conversation, but I want to point out to your comment about the CFO at Walmart saying in the last earnings call that they have a lot of cash that they're sitting on. Walmart's first half free cash flow was about $15.4 billion. And I'm not sure, even if this deal does happen, how Walmart and Microsoft are thinking about ownership, right? What is the correct divvying up measurement of how much they would actually be able to take ownership here? But I do want to say that Walmart has been successful in integrating in this sort of native advertising, native digital advertising in a way that Amazon has not even been so well at doing. So by that, I mean, there are $10 pair of men's jeans at Walmart that were very popular. And all of these young 13-year-old, 14-year-old, 15-year-old girls were taking to their mom's sewing machines and sort of refurbishing them, and it became a competition, right? And so whether that's happening organically or not, my idea is that Walmart is really planting these seeds, right? They have done a very successful job at finding this relationship with an unlikely customer. So all that to say, if Walmart does enter this mix, I think it could be a great sort of secondary channel, right, for them to continue to advertise and merchandise their products in a way that the sex appeal, perhaps, with Walmart has not been there. It has been sort of okay, these are your staples. You don't really go there for a splurge. But this sort of kind of retransformation and rethinking could be a really sort of ingenious way for Walmart to step into another angle and get these 100+ million customers, these US TikTok consumers.
Yes, we shall see. Of course, again, the political connections could be interesting with Larry Ellison of Oracle having some close ties to this administration. We're going to keep watching this. But as we take you to break, I also want to tell you I'm watching the dollar stores because Dollar General and Dollar Tree both came out with earnings. Dollar General shares are down less than 1%. Even though earnings per share beat estimates, revenue rose 24.6%. And like the Walmarts of the world, for example, stores that stayed open throughout the pandemic have fared better, particularly those that sell staples. Comparable sales at Dollar General up nearly 19%. The shares are down today. As I mentioned, the stock is up 28% year to date. So it could be a function of high expectations going into this report. Likewise, Dollar Tree shares are down more, 5.6%. Their comps rose by a little more than 7%. Their gross margin widened by 1.8 percentage point, but might not have been quite as good as the street was expecting. When we come back, we're going to talk more about housing sales and the effect that low rates have had on the housing market. We'll be right back. Pending home sales for the month of July rose by nearly 6% month over month. That is well better than estimates. And a lot of that increase coming in the Northeast, which saw a 25% gain. To make sense of this and some of the dynamics at play in the housing market right now, we want to bring in George Ratu. He is Realtor.com senior economist. He's joining us from Washington, D.C. George, it's good to see you. This is pretty impressive that we are seeing these kinds of numbers amidst what otherwise is not a great economy in terms of job growth, right? In terms of the coronavirus effect. Is it all to do with low rates? What is driving this?
Excellent question, Julian. And to your point, you're right. It seems that from the deep canyon that GDP dropped during the pandemic, the economy is taking the slow mule train up, whereas real estate markets took the helicopter and, going for a scenic ride. What's really driving this are two factors, main factors. One, absolutely, mortgage rates are fueling this activity. I mean, we're talking historic lows this year. In addition, what we're seeing is consumers. Consumers are looking for some degree of certainty in an uncertain world. And more importantly, given what we're seeing, the coming of age of remote work, the fact that even schooling takes place online in so many places this fall, people are looking for homes which can actually do more than double duty at this time around. So that's driving a lot of buying activity. We're looking on balance for really larger homes, home offices, bigger backyards, access to the outdoors, amenities, newer kitchens. These are the homes that really have to do it all, work from home, exercise from home, teach kids from home. So those are certainly the factors driving today's market.
George, it's Brian Chung here. We've been hearing from many guests on these programs over the past few weeks that housing is hot right now. Here in New York City, that's definitely not the surprise, with a lot of people wanting to move out of the major city and then into the burbs. But are there certain pockets and regions of the United States that are different than others, particular markets that are heating up more than others, or that aren't seeing the price rises or high bidding competition that other markets are?
Brian, the situation right now seems to be fairly generalized. To your point, we're seeing some of the metro areas, particularly in downtown urban cores, which might see a slight slowdown, especially as, to your point, New York, and it's similar when you look at San Francisco, is experiencing this slight exodus where people, again, understandably due to social distancing, and really the product, when you look for a bigger home, better school district, obviously most of those are going to be in suburbs, in small and mid-sized tiered cities. So whether it's Long Island, whether it's Westchester County, or some of the New Jersey counties for New York buyers, whether it's Fresno, Sacramento for San Francisco buyers, these are markets that are seeing a lot of drive. And frankly, right now, the hottest markets are those where we've seen really an active managing of the coronavirus pandemic. Markets particularly, that's why you see the Northeast, whether it's in pending or even new home sale. Northeast has fared very well, partly because the states in the area have been early and very aggressive with trying to mitigate the pandemic spread.
George, I'm still digesting last week's existing home sales numbers. Median home price sold in the US in July, $304,100. That's up 8.5% year over year at an all-time high. And thinking about how the supply is lowest on the lowest end and inventory overall, is down 22%. Talk about this affordability problem. I know it was sort of out of the main narrative for some time because it became so commonplace, but amid a financial economic crisis, how do you anticipate that homeowners, especially those who are struggling, who are depending on those stimulus checks, who perhaps have been laid off or furloughed for indefinite periods of time, that they can get back into the housing market one day?
That's an excellent point, Melody. And you're right. It's something that fell off the radar for a while, but it's been with us. If you look at the past decade, home prices have outpaced incomes by a pretty wide margin. And this year, to your point, we're seeing home prices accelerate in large part due to this what would be an otherwise classic economic problem, really strong demand meeting not enough supply. I mean, we started the year short and tremendously undersupplied. We're looking at 3.8 million by our calculations, new homes short of where we should be given population growth. And so, not surprisingly, a lot of folks are having a particularly hard time. And when you look at first-time buyers, when you look at the millennial generation, the folks that really are driving this year's housing market, that's in part why you're seeing this shift away from coastal, high-cost urban metros. Some of the hottest markets in terms of purchases have been in small towns. Think Columbus, Ohio. Think places in outside of Boston, smaller towns. To your point, mortgage rates have gone a long way this year towards mitigating the affordability concern. However, at the pace at which homes are rising, I do see this begin to pinch a lot of activity as we go into the colder months towards the tail end of the year.
And so, George, break it down for us in terms of the affordability gap and what that then does to the wealth gap, right? If people are not able to get into these homes, on the flip side, are they staying in places that they can better afford? I mean, walk me through what all that means.
Absolutely. And when you look at really a lot of sellers, particularly those who are in their home, if they are facing an employment concern right now, they're insecure, they do have the forbearance measures in place for them. And so for many of them, they actually have, in a sense, a grace period until next year. But those very concerns are what's keeping a lot of sellers on the sidelines and really promoting this supply shortage. So from my perspective, for a lot of buyers, particularly those who are still in the market, who feel secure in their jobs, there are several factors working in their favor. One, we've seen remote work come of age. I think that the employment numbers are better than they would have been were it not for the fact that so many companies not only maintain but increase their productivity as we are all working from home. So I think this is a tremendous asset for a lot of buyers who still have the opportunity to work remotely. In addition, I see the low mortgage rates continuing to support the housing environment. Where I think we've fallen a little short is really on the wage side. We haven't seen wage growth to the extent we really expected. We had a little discussion earlier about inflation. We're nowhere near 2% target. So I think for many buyers, the options are going to be in markets in the suburbs, in smaller cities, where the cost really is a huge and tremendous advantage. And the good news really for today's market is that economies across the US have seen much more improvement and diversification over the last decade. So there are many markets around the US which are able to support a thriving housing market.
George Ratu, a senior economist at Realtor.com. Thanks so much, George. Appreciate it. I want to bring you breaking news now. It's a headline from Politico that President Trump is going to unveil a $750 million deal with Abbott Labs for those new rapid tests that were announced. Remember, the FDA has just given an emergency use authorization to Abbott. They're $5 tests. They are rapid tests for antigens for the coronavirus. Those Abbott shares have already been up throughout the day on that FDA announcement. Right now, they're rising by 7.6% as we see this latest headline about the government potentially buying those tests. We'll be right back. Let's talk more now about the change at the Federal Reserve in terms of inflation targeting. Vincent Reinhart is joining us now. He's Mellon chief economist and macro strategist. He is joining us from Florida. He also is a former Federal Reserve official. So we have talked a lot today about how this wasn't necessarily a shock, right? That the Fed is sort of following on a number of years where it wasn't seeing 2% inflation. That said, as someone who was previously inside the Fed, can you give us some insight here as to how big of a change it is from that perspective, even if it's not a huge surprise? Is this a big change for the Fed?
Yeah, it's an incremental change. And I think it's important to work backwards. What do monetary policy makers worry the most about at this point in the business cycle? And that is investors getting ahead of themselves, looking at improving data and coming to believe the Fed would tighten too soon. So you want to control that risk. One way Jay Powell does it is he talks down the economy as often as he can about the long run headwinds on activity and the like. The other way is he just says he's not thinking about raising rates. Still another way is to rewrite your goals in a way that'll tolerate some overshoot of inflation. That's what they did today by targeting average inflation.
Vincent, it's Brian Chung here. I wanted to ask more specifically about maybe if there's anything to be gleaned backwards looking from the announcement today. It seemed like there were certain changes to the long run policy statement that might hint that the Federal Reserve regrets the interest rate hikes that it made in 2015 and then again in 2018. Wondering what your interpretation is of that.
Generally, you never say you're sorry because it only invites more criticism. I think the main message to take away is that Jay Powell's buying himself a little bit more flexibility. His two immediate predecessors were all about the science of monetary policy. Let's be specific about the rule. But what he told us is, well, you really can't measure maximum employment. You're going to have to look at a wide range of indicators. And the Fed would be willing to tolerate inflation going above its goal, just so as long as on average it's 2%. But did he explain what the average is? How much they'd be willing to tolerate inflation going above goal? How long he'd be willing to tolerate inflation above goal? Buying himself a little space. And in that sense, it's more back to the future.
Vince, I also want to come at this from another angle, which is potential moral hazard of leaving rates as low as they are for as long as they have been and potentially boundlessly into the future. We talked yesterday to Bill Campbell of Double Line Capital, and one of his theses is that what the Fed is doing, not just the Fed, but central banks around the globe, is not helping. It's not flowing to small and medium businesses, for example. We know it's flowing into the markets. We have seen equities certainly benefit, but that the income gap and wealth gap might actually be widening as a result of what the Fed is doing. Do you think that the Fed is cognizant enough of this? And is there anything they can do about it?
Well, the bad news is in the traditional transmission mechanism, it all goes through financial markets. That is the lever the Federal Reserve has. And it can be summarized kind of cruelly by saying the Fed's policy tool is to make the wealthy wealthier, i.e. you stimulate markets. They're uncomfortable with that, obviously. You wouldn't put that on the side of the building. So they emphasize really two things. One is they're going to be at the effective lower bound more often than previously thought. And that is essentially trend growth slower, people are uncertain. That's the time you should save more and invest less. And the market outcome of more saving and less investment is lower market rates. That's where we are. If that's the case, then the Fed needs to be willing to use its other policy tools. So I think they would say, yes, the traditional transmission of monetary policy can worsen inequities, can worsen income distribution. However, they can use other tools as well to provide some support, i.e. the 11 facilities they have going. And then the last point I think Jay Powell would make is to say, yeah, but Janet Yellen showed that when you run an overheated labor market, it benefits everybody. And so that's how the Fed is going to do it. make its most progress toward income inequality, making sure the economy is firing all cylinders.
Vincent, I want to ask about communications. So there's an argument to be made that all this is all about inflation expectations, managing inflation expectations in the future, not necessarily right now. There was nothing about the announcement this morning that's at an actual policy decision. So from that aspirational standpoint, how is inflation targeting or flexible average inflation targeting, as they announced this morning, an easier thing to communicate to the average person than prior to that, which was we have an inflation target of 2% and it's symmetric?
Or it may have been even easier when it was Volcker and Greenspan saying price stability is when people are not worried about changeable prices. I think average inflation is a more difficult concept. You're exactly right. And that's why I meant earlier, he's buying himself more space to be flexible. He's buying some discretion. Also notice that back in 2012, when they first wrote this statement, the expectation was it would be written in stone. This is the longer run strategy for monetary policy. Every year the committee will endorse it, but they wouldn't be tinkering with it every year. This version is very situational. It talks about where they are right now, effective lower bound. They talk about average inflation targeting, but they only give the example from below. Given an average, and now that we're below average, we'll tolerate an overshoot. There's two ways to take that. One is, okay, it's the problem in the moment. The other is they're showing what is the credibility problem of an average inflation targeter. You're willing to overshoot when you were below, but do you think the Fed, if inflation were above 2 and it got down to 2, it would continue to tighten monetary policy to get on average inflation at 2? Probably not. It's not a symmetric rule.
Vincent, thank you so much. It's great to see you as always. Vincent Reinhart is Mellon Chief Economist and Macro Strategist. Thanks.
Thanks for having me.
Coming up next, we're going to talk about a solar spinoff. Maxion starts trading today separately from SunPower. We're going to talk to the CEO. Stay with us.